So what happened in global markets in July 2026? I'm Kevin French, and this is Core Wealth's monthly wrap-up. It's all about AI again. In July, we actually saw quite a bit of turmoil because there was a Chinese large language model that came out and was rated higher than Anthropic's Opus model in the month of July. So questions were arising again as to whether the huge investment going into AI infrastructure, expected to be around $1 trillion in 2027, will actually generate a return if there are cheaper, quicker models available. Oil is the other global recurring theme. We saw it actually breach $100 a barrel again in July, but at the time of recording now, it's back closer to $80 a barrel. And this is just influenced by whether their negotiations are going well or not. And we saw some further attacks, not just in the Strait of Hormuz, but closer to the Red Sea by the Houthis, and this scared the market again. We've seen the US add further tariffs again after the previous one. Some of them were blocked. And this has scared the market a little bit with regards to emerging markets, as you'll see later. On the South African side, we actually saw some interesting moves by the Reserve Bank. Initially, inflation had come out higher than expected, but yet they chose not to increase interest rates. They had already earlier this year because they are wanting to try and support growth in South Africa. This was a really good sign, and the South African equity markets responded accordingly. So let's have a look at how the different markets have performed in US dollars around the world. From the slide, you can see that it was quite a mixed month. Developed markets up slightly, just 0.5% up, but emerging markets actually pulled back quite a bit, down 3.1% for the month. Listed property globally, again, not a good place to have been. And the Japanese equity market coming off quite strongly, over 5% for the month. And Chinese equities also down. However, the standout on the developed market side was actually the UK stock market, and that was up 5.1% for the month. If we have a look, though, at the year-to-date numbers and the 1 year and longer numbers, we can see that pretty much all equity markets have really generated some good returns in clients' portfolios. Let's have a look at the South African markets for the month of July. On this slide, you can see that it was a pretty good month for South African markets. Really just the bond market that took some strain during the month, down 1.4% on the back of concerns that the Reserve Bank didn't increase interest rates when they were expected. But equity markets looking good. Although year to date, we can still see the South African equity market is down. Over the last year, some really strong returns, and that feeding through into the longer term figures as well. Listed property, really the place to have been over the last year and over the last 3 and 5 year terms. Over the month, we also saw the rand weaken slightly, and we saw all major currencies gaining somewhat on the rand during the month. And over the last year, the rand is still stronger than all of these major currencies. This month, we're going to have a look back at our retirement growth investment model. You can see on the slide that this model was launched in November 2012. The now almost 14-year track record is shown on the graph on the right-hand side. And we can see that the purple line, which is this strategy, has outperformed its peer group substantially over that period. A key tenet of this strategy is to maximize growth asset exposure, in other words, shares both locally and offshore, and listed property, in order to maximize growth while investors are saving towards their retirement. What we're having a look at this month is Coronation, who are one of the equity managers. You can see here on the graph on the left-hand side, it has comfortably outperformed not only the all-share index, but also the peer group, and we're showing you performance here since 2008. We're highlighting 3 of the top holdings, namely Standard Bank up really strongly over the last year, Naspers, which is really a play on the Chinese tech market, actually down over the last year, and Aspen Pharmaceuticals, which is up also quite strongly over the last year. These managers are included in our portfolios because they've demonstrated their ability to choose the correct stocks over time. The research we're going to have a look into now is just what has driven the Johannesburg Stock Exchange returns for the first 7 months of this year. The Johannesburg Stock Exchange started the year really strongly, and up to just before the end of February, it was up at around 128,000, the index. However, following the start of the war in the Middle East, it slid quite dramatically. But some of the key drivers of this fall has been how concentrated the market is. Just the top 20 shares on the Johannesburg Stock Exchange make up more than 64% of the actual market. And if we just take platinum and gold miners, they make up 25% of the market. When you have a few names carrying the whole market and something happens in their particular area, that can have a dramatic effect on whether the market is up or down in a short period of time. One of the areas that impacted quite dramatically was what was happening to gold miners. Now, you may remember that 2025 was a really strong year for gold and drove the market quite strongly. But if we have a look at this slide, we can see that in January, the gold price was just under $5,600 an ounce. It then collapsed by almost 30% down to just over $4,000 an ounce. That was its worst quarter in more than 10 years, in more than a decade. At the same time, platinum and silver fell as well. And what you saw was that with gold and platinum miners making up almost 29% of the index, that reversal dragged the whole market lower during the first 7 months of this year. One of the other key drivers of the JSE is the tech sector, and that's essentially two shares, Naspers and Prosus, and they are a play on the Chinese tech company Tencent. In this picture, you can see that the graph on the left just shows how Tencent has fallen by almost 30% during the first half of 2026, and that accounted for around just over 2% of the JSE all shares fall during that period. The other area that was a positive has been our financial sector, and that makes about 30% of our index. But you can see on the right-hand side, some of the banks doing particularly well during the first 7 months of the year, and they were able to actually make up for the negative that we saw from the tech sector. One of the reasons why we include a number of good stock pickers in our portfolio is during times of concentration like we've seen, they're able to generate outperformance. And we saw that this year, and the Johannesburg Stock Exchange to the end of July was down 1.8%. If we have a look at Coronation, they were up 1.4%, and another manager we use for equities in our tax-free savings investments, Aylett & Company, they were up 3.3%, demonstrating this ability to pick stocks, especially during tough times. Here are our sterling or UK global strategies for clients who look at the world through a sterling lens. And we can see some really strong outperformance over the last year. The growth strategy up 17.6% in pounds, and that is a 4.5% outperformance of the class average. The longer term numbers, which in October will be a 5-year track record, some healthy outperformance, getting close to 2% outperformance of their peers. So here are our US dollar global models, and we can see a really healthy picture here over the last year, ranging between 12.3% on our defensive model to almost 22% return in US dollars in our global growth model. And then the outperformance is something that is really encouraging. Over the last year, the level of outperformance of the peer groups would be the equivalent of getting some 40% more growth than if you would just manage to achieve the peer average. This is something that we're very happy with. We wouldn't expect the outperformance to stay at that level every single year, but as you can see here, over nearly a 10-year period, we've generated returns of around 2% ahead of the peer group, which is quite significant if you look at the absolute return. I hope you found that helpful. Two things. One, if you have more questions, please get hold of your advisor. We'd love to engage with you. Two, if you are interested in having a look at any more of this, please go onto our social media, have a look, like, subscribe, all those good things. And if you have questions, please drop them in the comments below. Thanks again.